You know that incredibly frustrating feeling when you're doing absolutely everything right with your money? You're saving a chunk of your paycheck, you're investing early, you're working your tail off, and yet, when you check the scoreboard, it barely budges? Well, you're definitely not alone. The harsh truth is, the ultra-wealthy aren't just outworking you. They're playing an entirely different game. So, in this explainer, we're going to break down the ultimate system used by the ultra-wealthy, and it's going to completely transform how you look at building long-term wealth. All right, let's dive right in.
Look, there's a stark contrast between conventional money rules, saving pennies and grinding away for a salary, and the true wealth laws. Those old rules, they just keep everyday investors stuck on a treadmill going nowhere. The ultimate system actually relies on three pillars: momentum, structure, and asymmetry. This isn't about, tweaking your budget for incremental savings. This is the actual architecture of how long-term fortunes are built and sustained.
And that brings us to this massive paradigm shift. Money doesn't follow rules, it actually follows laws. The source material for our explanation today comes from this fascinating journey of a guy who went from being a literal janitor to building $2 billion companies and managing billions over at Goldman Sachs. And what he realized through that incredible ascent is that if you want to build real wealth, you have to completely unlearn the traditional rules and start strictly obeying the unbreakable laws of money.
So, here's our roadmap for today. We'll start with the core system. Then we'll hit Pillar 1, momentum, Pillar 2, structure, and Pillar 3, asymmetry. Finally, we'll tie the whole shebang together with an actionable checklist.
All right, Part 1, the core system, understanding the architecture of wealth. Let's get into it.
The absolutely crucial thing here is understanding the specific job of each of these three pillars. So, the job of momentum is to figure out how you can actually compound your money. The job of structure is all about determining exactly who controls the money and what specific outcomes you're getting. And the job of asymmetry, that's to maximize your upside while completely minimizing your downside. Everything we talk about today is going to snap right into one of these three architectural pillars.
Moving right along to Pillar 1, momentum. And the governing rule here is Law 1. Money loves speed, wealth loves time.
It is such a massive trap to confuse fast action with fast results. Our source shares this brilliant story about his early days in real estate. Over a 5-year period, he acted with incredible speed, aggressively flipping 100 homes for quick cash. But during that exact same 5-year window, a friend of his took a totally different path. This friend bought one single-family property, waited, rolled the money into a 4-unit complex, waited, and eventually he scaled up to a 20-unit complex. Now, at the end of those 5 years, the host had flipped 100 homes, sure, but his friend owned 20 units and had a net worth 5 times larger. Speed is just the short distance between seeing an opportunity and acting on it. But time is making a good decision and letting it sit.
To really wrap your head around the incredible impact of compounding time, I want you to think about this number: 5 million%. No, seriously, that is the mind-blowing total return Warren Buffett achieved at Berkshire Hathaway between 1965 and 2024. He completely flipped the idea of fast money on its head. He just bought high-quality companies and held them forever, compounding at almost 20% annually and beating the S&P 500 by double. Time is, hands down, your absolute best partner in wealth creation.
Okay, let's jump into Pillar 2, structure. This is going to cover Laws 2, 3, and 4, all about how deals are structured and who really holds the purse strings. So, Law number 2, he who gives the money has the power. If we take a look at the Forbes 400 list and categorize exactly how the wealthiest people got there, the breakdown is shocking. Earned income, meaning just working for a salary? 0. Literally none of them. People who sold a business? A few. Guys like Mark Lohr or Gan Gilbert. But the vast majority of that list, they are continuous buyers and builders. We're talking people like Elon Musk, Jeff Bezos, Warren Buffett. Buyers wield the power because they're the ones giving the money, which means they dictate the terms. Even if you don't have billions in cash sitting around right now, obsessing over the buy and build strategy is what gives you the ultimate unfair advantage.
Now, once you step into the role of the one giving the money, you need tools. And that leads us straight to Law 3. Leverage multiplies everything. Leverage does 4 really incredible things. First, it's the ultimate economic growth engine. Without it, the entire trillion-dollar private equity industry literally wouldn't exist. Second, it forces you to get educated on risk. Third, it's a game of collateral. Loans are tied to hard assets like buildings or stock, which is what makes the leverage manageable. And fourth, this is huge, massive tax advantages. Think about when Elon Musk bought Twitter for $44 billion. He didn't just sell all his Tesla stock and trigger some massive tax bill. No, he borrowed against it. Leverage produces no income, which means it produces no taxes. It magnificently multiplies what you've already built.
But here's the catch. Leverage alone doesn't make you wealthy. That brings us to Law 4. Cash flow keeps you alive, but equity makes you free. The breakdown of McDonald's wealth is absolutely staggering. Most people assume McDonald's makes its wealth selling burgers, right? And sure, those franchise royalties generate an impressive $1.6 billion in cash flow. But the true wealth, that lies in nearly $45 billion of real estate equity. Cash flow is what funds your current lifestyle. It pays for your house, your car, your vacations. But equity, that's the wealth that creates your freedom for tomorrow. High earners often get completely stuck chasing the stability of cash flow, and they miss the equity game entirely.
All right, into the home stretch. Let's shift to our final architectural pillar, asymmetry. Covering laws 5, 6, and 7, this is where we learn how to make sure risk and reward don't scale evenly.
Law 5 tells us that risk and reward are nonlinear. Take venture capital portfolio theory, for instance. Say a VC firm makes 5 investments of $100,000 each. Their maximum downside is strictly capped at $500,000, right? Now, maybe 2 of those bets fail completely, going to absolute zero. One just breaks even. But then one goes 10x, and that last one is an asymmetric winner that goes 100x. By keeping their downside strictly capped, that single massive asymmetric return easily wipes out all the losses and generates vast wealth. See, the goal isn't to put $100 in and just get $100 back. The goal is to cap your risk at $100 and structure the upside to potentially capture $10,000.
But I know, hearing asymmetric upside makes some people want to just go all in. Which brings us to Law 6, don't bet the empire for a pot of gold. Our source shares this heartbreaking cautionary tale of a friend who systematically saved $700,000 over 15 years, only to lose every single penny by dumping his entire life savings into one seemingly perfect oil and gas deal. The lesson here is all about sizing your bets. As Ray Dalio puts it, protect the machine that produces the opportunities. The greatest investors in the world don't just blindly chase higher returns. They obsess over reducing risk while keeping those returns exactly the same, ensuring they never, ever bet the empire.
And once you've sized your bets, how do you actually protect them? Well, Law 7 tells us that diversification is actually just a hedge against ignorance. What's truly fascinating here is how the wealthy totally defy traditional Wall Street advice. Wall Street tells you, hey, spread your money everywhere. But if you understand the risk deeply and you have high control, like say in your own business, you concentrate your bets. You put all your eggs in one basket. You only fully diversify when you neither understand the risk nor have any control over it. And that's exactly why billionaires like Bill Gates or Elon Musk keep their net worth highly concentrated in the machines they actually control.
So, we've covered the laws of momentum, structure, and asymmetry. Now let's bring this entire core system together. Here is the actionable checklist. 5 questions to ask before investing. Because look, just knowing the laws isn't enough. You've got to apply them systematically. Before making your next financial move, run it straight through these 5 explicit questions from our source's blueprint. Number 1, can this compound over time? Number 2, who actually has the control here, you or someone else? Number 3, what happens if it completely fails? Is your downside capped? Number 4, is the upside truly meaningful and non-linear compared to the downside? And number 5, do you genuinely understand the risks well enough to explain what could actually go wrong? I challenge you to apply this precise filter to every single opportunity you encounter.
The rules you've been taught your whole life were designed to keep you safe, but the laws we've explored today, they're designed to make you free. You now understand the core system of momentum, structure, and asymmetry. So, I want to leave you with this provocative question to chew on. Ditching the old money rules, how will you allocate your next dollar using these exact wealth laws? The scoreboard is entirely yours to change. Thanks so much for joining me on this explainer, and I'll catch you next time as we continue to break down the complex into the achievable.